Welcome to FunVeda, your exclusive channel for everything mutual funds. So, let's talk about something that's probably on a lot of your minds right now. What on earth is going on with small cap funds? You know, they promise these incredible returns, but boy, do they come with some serious risks. Today, we're going to break down exactly how to navigate this, let's call it a volatile but potentially very rewarding space. But first, as always, we have to get the most important message out of the way. Mutual fund investments are subject to market risks, so please read all the schema-related documents carefully before you decide to invest. And just a quick heads up, everything we're about to discuss is for your information and education only. We're not giving out any investment advice here, and all the data you're about to see is as of February 6, 2026. All right, let's get into it. Here's a quick look at our game plan. We'll kick things off with the current small cap landscape. Then we'll get into the big debate, short-term versus long-term performance. After that, we'll show you how to measure the real return, not just the flashy numbers. We'll also meet some young stars in this category. And finally, I'll give you a simple framework you can use for your own analysis. Okay, first up, let's talk about today's small cap landscape. And yeah, we need to acknowledge the turbulence we've all been seeing lately. Let me just ask you straight up, have you been looking at your portfolio lately and, well, feeling the heat from the recent performance of your small cap funds? I bet if you are definitely not alone. And look, this right here confirms what so many of you have been feeling. Just look at these numbers for some of the biggest names out there. HDFC, Nippon India, SBI, Kotak, they've all taken a pretty decent hit. The main takeaway here isn't just that one fund is down, it's that this recent correction has been really widespread. So this brings us to a really important question. Is this just some short-term pain, or is there still some serious long-term gain to be had? We need to put all of this performance into perspective. Now, if we zoom out just a little bit to the 1-year mark, the picture still looks, well, pretty challenging, doesn't it? HDFC small cap gave a pretty modest 4.5%, Nippon India just over 1.5%, and SPI small cap actually gave a negative return of minus 2.7%. You see this, and it's really easy to get discouraged. But now, watch what happens when we zoom all the way out to the 10-year mark. This is where the entire story just flips on its head. The exact same funds that have been struggling have delivered absolutely incredible annualized returns over the decade. We're talking over 18% for HDFC, over 20% for Nippon India, and close to 18% for SBI. This just shows the incredible power of patience and staying invested through the ups and downs. Okay, so if those long-term returns are the goal, how do we pick the funds that can actually handle the journey? Well, for that, we need to measure the real return, and that means looking way beyond just the surface-level numbers. The first tool in our kit is called standard deviation. Think of this as the fund's wobble factor. A high number just means the fund's journey is going to be more of a roller coaster, with bigger climbs and much steeper drops. It's a straight-up measure of how bumpy the ride might get. Next up, we have beta. Now, this one tells you how much a fund basically amplifies the market's mood. A beta of 1 means it pretty much moves in sync with the market. But if you see a beta of, say, 1.2, that means if the market goes up 10%, that fund tends to go up 12%. But remember, the same is true on the way down. And finally, we have the Sharpe ratio. Now, this might just be the most important one of all. You can think of it as the bang for your buck ratio. It answers a simple question. How much return are you getting for every unit of risk you take on? It's simple. A higher Sharpe ratio means the fund has been way more efficient at its job. So let's see this in action. Here we've got two funds, Invesco and Mahindra Manulife. At first glance, their 3-year returns are almost identical, right? But look closer at the Sharpe ratio. Invesco has a slightly higher one. That means it delivered pretty much the same return, but with a little less risk. It's a subtle difference, but it's important. It tells you you're getting a slightly smoother ride. Speaking of newer funds, it's time to meet some of the young stars. These are some promising funds that don't have that long 10-year track record, but they're definitely catching investors' attention. Take Mirae Asset Small Cap, for example. It's delivered a really solid 11% return in its very first year, and that's in a tough market. And we just saw Mahindra Manulife's strong 3-year performance. The point here is, while a long track record is what we ideally want, it's still worth keeping an eye on these newer funds that are executing their strategy really well right from the start. So, to pull this all together,
Let's build your very own analysis framework. Think of this as a simple checklist you can use anytime you're doing your own research on a small cap fund.
First, and this is non-negotiable, you have to look beyond 1 year. Prioritize that 5 and 10-year track record. Second, always compare the Sharpe ratio to see which fund is working more efficiently. Third, check the AUM, the assets under management. A massive fund like Nippon India's with over 68,000 crores can sometimes find it harder to be agile. It's just tougher to buy and sell smaller company stocks without moving the price. And finally, and this is the most important part, know your own risk profile and match it to the fund's volatility.
And that brings us to our final thought for today. After seeing all this data, the sharp short-term falls, but also the really impressive long-term growth, I want to leave you with this question to think about. How does this balance, this trade-off between long-term potential and short-term volatility in small caps, fit into your personal investment strategy? Thanks for joining us on Funveda. We'll see you in the next one.